Hi, I'm James Robinson, and this is my stock pick of the week. This is part 4 in my series on Westwood Holdings Group. Today we're going to talk about Westwood's dividends. So when looking at the company's dividends for Westwood Holdings Group, the first thing I want to show you, this is the slide on what they've done between 2000 and 2019, which is the last year we have full results for. And you can see they look great. Up till 2002, they paid no dividends. From 2002 on, they've gone from paying no dividends up to paying almost $25 million in dividends, which works out to about $2.50 a foot in dividends, or $2.50 a share rather in dividends. So that obviously sounds really, really great, and it's a reason to be really interested and excited about the company. And that's exactly what you shouldn't be looking at, believe it or not. One of the things that comes from doing your homework is you figure out some things that are going on with the company that makes a company less attractive. This company has gone from paying these dividends in 2019. In 2020, they have suspended the dividend. Now, they suspended the dividend, I suspect, for 3 reasons, and we're going to go into those 3 reasons. But hopefully you spend the next few minutes watching the video to figure out why, and to figure out why, despite the fact they've suspended the dividends, I continue to think this company is probably a pretty good investment. As always, when I look at a company, I try and look at the company's dividends. When I try and look at the company's dividends, I do it through 4 factors. I look at the absolute yield and growth, what's happening and how that's changing over time. I look at the dividend safety in the context of earnings, and the dividend safety in the context of cash flow, and the dividend safety in the context of debt. So what I'd like to see is how much of the company's earnings are being spent on, how much company earnings are being spent on dividends, and is that number too high or is that number sustainable? And then I do the same thing with cash flow, and then I also say to myself, well, if the company has a lot of debt, if the debt were to increase gradually or dramatically, at what point does the debt service become so great that the company couldn't continue to pay its dividends? And so let's figure out what we can learn about this company by looking at the dividends through these filters. So the first thing that you can look at is this chart. I've changed to show that the company's current yield is 0. The average yield for the S&P 500 is 1.73%. This company had averaged over the last 5 years an average growth of 11.8% in their dividend yield. So that would be great, except for the fact that they've suspended it. Now, I don't think they've suspended it strictly because of COVID. I'm going to talk about that in a few minutes. But generally speaking, this would be a pretty exciting chart. You would see that the company's dividend yield has been great, although again it's 0 now, and that the rate of that growth is greater than the rate of inflation, which means that if you were buying this company as part of a retirement program, your retirement would get a little bit nicer every year because your dividend income is growing faster than the rate of inflation, and therefore your retirement is cushier. But this again doesn't tell the whole story. When we look at the dividend in the context of earnings, what we're really looking at here is the payout ratio. So the payout ratio is what percentage of the earnings are being utilized to pay dividends. The average payout ratio for the S&P 500 is about 40%. So if I see a company is spending more than about 40% of their earnings to pay dividends, then I start to ask myself, what's going on? Why is that? It doesn't mean I won't invest in the company. It just means I need to have an explanation for why that is. When I see that the earnings are less than 40%, then again, I say to myself, okay, they're not paying me as much as other companies are, so what are they doing with the money, right? But this company, the average payout ratio for the last 5 years has been 156.9%. So for every dollar of earnings, they're paying $1.59 in dividends. That, as you can imagine, is not sustainable. And when you look at that and say it's not sustainable, you have to ask yourself, so what's going on and how can they continue to do this? And again, when you understand what's going on in the company, you see the earnings have kind of been flat for the last 5 years. The earnings are the green bar, and then they dropped dramatically in 2018. And we know that they're not going to do as well in 2019. So this actually says 2018, but it's actually 2019. But we also know that they dropped even more for 2020 because of COVID. So you add all that up and you go, okay, so if these dividends aren't sustainable, what's likely to happen? And the fact is, I've been following this company for a long time and would like to have bought it, but I thought the dividends were too high. Now what's happened is the dividends have gone to 0, which is an appropriate adjustment for the company to make. The company's stock price has taken a big hit because people who were buying this for the dividends have now sold it. People are very scared that the dividend isn't there, and so there's been an overcorrection, and I think the company's stock is worth less than it ought to be, and that's because the dividends have gone down so fast. But if you've been watching the company and doing any homework on it and done your research, you would have recognized these dividend payments were completely unsustainable, and the company either had to have a massive increase in its earnings, and there's no evidence that it was growing their earnings that quickly, or they had to make an adjustment in the dividends. And so my strategy had been to watch the company, even though I liked it, not buy it, wait for this correction. And now that this correction has come, I was very comfortable buying it because it's sort of moving along a course that I predicted it would move on, which is these earnings would have, the dividends would have to be struck down to zero. So the next thing that I look at in terms of dividends is dividends in the context of free cash flow. And you can see even here that the average payout ratio for the last 5 years has been 80%. But even that's a misnomer because in 3 of the last 5 years, it's been more than 150% of the cash flows. So this is sort of reiterating which I had thought before, which was these dividends are unsustainable. This company's going to have to cut its dividend or borrow money. And if it borrows money, I'm not going to look at the company anymore. But if it cuts its dividend, that might be a good time to buy because I think the market will overreact. It has cut its dividend, the market has overreacted, and now we've got an opportunity to buy a great company. What I think is a great company, I think a company that's going to rebound after COVID. And we're buying it at basically book value of the company, maybe even slightly less than book value of the company. And so this dividend thing, while normally I only buy companies that pay dividends, and we're going to see in the wealth creation video that I do tomorrow, you're going to see that there's some other things happening with the money they're not currently paying in dividends that will give us reason for celebration. So dividend saving in the context of cash flow, there really is further reiterating which I thought, which was that the company ought not to be paying a dividend at all, and they are now not paying a dividend at all. Usually I will do a video of a dividend safety in the context of debt, and I have a slide there that shows you as the interest rate goes up, the debt service carry will go up, and at what point does the interest payments and the debt service supersede their ability to pay dividends, and thus the debt becomes a problem for the company's dividend paying. This company, A, currently is paying no dividend, and B, currently has no debt. So that slide isn't really appropriate. I didn't create one for you because it doesn't show you anything of value. But what I wanted to talk about here is that, this company is something that we should be considering buying, not because it doesn't pay a dividend, but because it stopped paying a dividend when it should have. And now that it stopped paying a dividend, it's out of favor. And once it's out of favor, we have an opportunity to buy it at a real discount. So that really is the summation for the dividend section on Westwood Holdings Group. Thank you very much for your time.